month ago, I made two posts over on Twitter. One was a bull thesis for Hershey stock, and one was a bear thesis for Tesla stock. And in the last month, Hershey stock is up 19.5%, and Tesla stock is down 32%. In today's video, we are going to go over how I fundamentally analyze stocks so that you can find and identify moves like this for yourself. The best way to pull fundamental data of a company to help you decide whether it is a good investment is the following. Let's start with Hershey, the first stock that I tweeted a bullish sentiment on. What I'm going to Google search is Hershey revenue macro trends. I have no affiliation with this website at all. They're not paying me. I don't own it, anything like that. It's just the best collection of charted data like this. And this is where I pulled the information that you saw in that post of the trailing 12-month revenue of Hershey. And this site is much more than just revenue. If I come back to the top of this page, you have all of these options to select from. Another metric that I like to look at and compare when looking for stocks to invest in is the price to sales ratio. You can also click into that and you get a chart of the price to sales ratio alongside the stock price and the trailing 12-month sales per share. So this is also extremely useful data to use to compare and help decide whether stocks are good fundamental investments or not. Now we're going to go back to that macro trend site later in the video because there's a lot more fundamental analysis that needs to be performed on the data provided there to actually decide if a stock is a good purchase or not. But first, let's talk about scans that we can build within ThinkorSwim to help us decide which stocks we should even be looking up. Because you can't just, you can, I guess you could just go randomly look up stocks on that website to find good setups. But a much easier way is to build scans that return us stocks likely to have decent setups, then take those over to the site. So if you take a look at the scanner I have set up now, the two important filters here are these fundamental filters. I have the price to earnings ratio set to a minimum of 50. I'm going to go over a couple of scans here with you. The purpose of this one is to find stocks that the market is expecting high growth on. Let's agree with the market, right? The market is not always right. It's definitely not always right, but it's usually more often right than it is wrong. So the purpose, once again, of this scanner is to find stocks that the markets are expecting high growth for. Then, of course, we will take the stocks on the list. We'll go do our own analysis and see if we agree or disagree. That can provide either long or short opportunities alongside the stocks from this scanner. Anyway, price to earnings ratio set to a minimum of 50 and an earnings per share 3-year average better than 0.01, basically a positive EPS over the last 3 years. The company is also making money. Now, also very importantly, I have added a custom column. Actually, it's not custom. This one is default within ThinkorSwim, but I have added the price to earnings column to my scan results, and I am sorting ascending top down by that. So I can see the stocks at the top of my list that have the highest growth expectations in the market. Right now, the top of the list is BCH. This is Banco de Chile, and it currently has a price to earnings ratio of almost 1900, which is crazy. Actually, funny note here, and another great use of macro trends, I hopped on over to our website and took a look at the Banco de Chile PE ratio because I was like, 1800 is obnoxious. Why is it so high? And I realized this site says the price to earnings ratio is only 8.5 on Banco de Chile. So what's going on? I failed to notice immediately in running these scan results. What is showing on ThinkorSwim is an ADR, which is like an American Depository Reserve. Is that what ADR stands for? Something like that. Essentially, it's not direct shares of the company. It is just a conversion of this company that makes it easier for American investors to own. Obviously, Banco de Chile is a foreign company. This ADR and the value associated with this ADR should not be directly associated with the company. So let's skip over these first two sort of ADR stocks here, and let's look down at the first one that's not an ADR, ALTR, which has a price to earnings ratio of 681. If I hop back into my, what was it again? ALTR. Let's just make sure this one is right before we move forward. ALTR does in fact have a price to earnings ratio. Macro Trend says it's even higher at 694. Obviously, you can see the stock price here is flying. You get an idea of the earnings per share. And if we hopped into the revenue of this chart, hey, you can see, guess what? This is a very strong and growing company. So as of this moment, the market seems to be right in assuming this stock will be growing and will continue growing throughout the future. Hey, ADR stands for American Depository Receipt, by the way. I was close off the top of my head. Cut me some slack. We'll talk more once again about how you analyze stocks fundamentally over on the Macro Trends website. Just before we do, let me show you one more scanner that I utilize within ThinkorSwim to find types of stocks to look up on Macro Trend, right? I call this one my Warren Buffett scanner. Essentially, the last one was looking for growth stocks, right? Stocks with very high price to earnings ratios. This one is looking for more value stocks, actual strong, fundamentally sound companies. I have the earnings per share set to a minimum of 0, the EBITDA set to a minimum of 0, and the net income set to a minimum of 0. Essentially, all three of these statistics must be positive. The company must be making good money. Now, I also have the book value per share growth 3-year average set to a minimum of 10. So they must be making money, and over the last 3 years, they must be growing, right? These must be growing companies. Then I have a couple of study filters set on so that I can find specific chart setups. The first is that the current price is less than the 200 simple moving average. So essentially the stock is macro, larger picture, weak, beat down right now, and the relative strength index study value is less than 40, which equates to the stock is right now weak. So what we're looking for here, Warren Buffett-esque style, is stocks that are making money, growing, but currently beat down. So just sort of a little bit of a different side of investing. This is more for your value investor, whereas the first scanner was more for your growth investor. I sort of like to do a little bit of a mix of both. Thus why I built and published both scanners. The first stock on this list right now is PWR. Oh, sorry. I forgot to mention, also in the sorting of this scanner, I have it sorted rather than by price to earnings, by sales per share. So the companies at the top of this scanner are the companies that are making the most money per share out available on the open market. That's how I sort my scan results here. Anyway, first stock on the list, PWR. Before I go over exactly how I perform my fundamental analysis using the data provided by the Macro Trend site, I need to let you know that if you're interested in the two scanners that you just saw, they, alongside over 120 other custom coded scanners, strategies, studies, you can even copy my exact ThinkorSwim workspaces, are all available on my website, daytradingstrategies.net. You can sign up to access those within the Our Codes link, or if you would like to learn how to build your own custom codes within ThinkorSwim, I have published a 10-chapter, 36-section course. Every section comes with a video lesson by me, as well as a text lesson. I think it is a great way for you to learn everything you need to know about ThinkorSwim coding. But of course, don't just take my word for it. I'm obviously biased. If you're at all interested, head on over to the site, read the reviews. You can do that by clicking the link in the description down below. Go on, sign up, and become a better trader today. So back over within the Macro Trend site, I am now on the revenue page for PWR, the top stock on our Warren Buffett scanner. And if we come down and look at the quarterly and trailing 12-month revenue growth, This thing looks very, very nice. A very fundamentally sound and growing company. It's actually interesting to me that this thing would be currently weak. I haven't even looked at this chart yet. I'm going to assume, because I've obviously done analysis on hundreds, actually easily thousands of stocks, I'm going to assume that this stock was a very strong grower and maybe just recently announced earnings, because today is March 10th. The data on macro trends is only available up through December. I'm going to assume that they just announced earnings that was bad and made the stock gap down. Let's actually head on over to the chart of PWR and take a look at if that is true. Here's the chart, and I was pretty much right. It looks like this was an extremely strong, growing company. Looks like it got some kind of bad news. Actually, let me get the what is it? Show corporate actions turned on. Was this earnings? It actually doesn't look like it was earnings. Earnings was announced on February 20th. That looks like it also made the stock come down, but there was some kind of news that occurred here on this ticker that is driving the price down. Of course, below the 200 SMA, below 40 on the RSI, which is why it is appearing on our scanner. It is still a really strong, fundamentally sound, growing company. Just looks like it got some kind of news that is driving it down. So the next step you'd want to find out is, what was this news, and do you agree with the news versus the growth story that the stock should be beat down this hard? So let's go see if we can figure it out. The easiest way nowadays to figure out why a stock gap down is to go ask ChatGPT. Utilize AI, utilize the technology you have at your fingertips. So let's just ask, why did stock ticker PWR gap down so large in January of this year? Let's go ahead and see if ChatGPT has any reasons for us, if it'll load anything at all. Right? The internet is so, I think AWS is down today. The internet's been slow kind of everywhere. Anyway, experienced significant gap down. Yes, of course. Downward reversion of the company's price target by Truist Financial. Okay, so they got some analyst downgrades. While the price range adjustment may have contributed to the stock's decline, the absence of other significant news suggests the market dynamics and investor sentiment also played roles in the gap down. So all that, by the way, provides you a little stock chart here. That's interesting. I didn't know ChatGPT did that. But that's interesting. So really all ChatGPT says, and I did go and sort of read through the news on Yahoo as well. I like to utilize Yahoo Finance for my individual stock news. I don't know. I can't really find a good reason why the stock gapped down so large in January. Now, it did have a bearish reaction to its most recent earnings, so I get that. Seems like the earnings didn't come in as strong as the market expected. And also, just the entire market is pretty down right now. I mean, since February, late February, so basically the last 3/4 of a month, the market is getting hammered. So let's not, avoid that when looking at this stock either. Of course, this stock will be going down alongside the market, but with all the factors that I've found so far, and note, I took about 3 minutes to look up the news on this company. I'm not going to sit here and take hours to do research on this company. I'm probably not actually going to go buy it. This is just sort of showing you all how I go through my process. So maybe take a little longer to deeply research this if you are interested in buying this company, but you get the idea. This stock is an extremely strong, growing stock. If we hop back into the macro trends page for this, extremely strong revenue growth. Very, very nice. Actually, we haven't even done this yet. Let's go look at the price to sales ratio of this ticker. Hell, the price to sales ratio on this stock is only 1.5. It is only trading at a 1.5 times multiple of its sales. It seems to be valued really nicely. It seems to be growing really strong. And on the current beatdown, other than just trading down alongside the overall market weakness, I can't find any real reasons. To me, this stock looks okay. I'm making this video on March 10th, 2025. Come back in 6 months and roast me if I was wrong. But to me and my current state of fundamental analysis on this ticker, I like PWR. And that kind of hopefully gives you an idea of how I do my fundamental analysis on tickers like this. Now let's talk about how I found the examples from the intro of this video, starting with Hershey. Remember how I just talked about that the overall market over the last 3/4 of a month or so is getting hammered? I mean, the S&P 500 in the last X number of bars or whatever, let me look here, in the last 13 bars is down 8%. That is a really hard drop for the S&P 500. Yet Hershey, over that same time period, or over a similar time period at least, over the last 20 bars, is up 24%. Like, not to stroke my own ego or anything, but that is amazing. Like, that's an amazing call to be able to find a stock, and a massive stock too. Like, Hershey is Hershey. This is a huge market cap company that is this strong in the face of that much of a market bloodbath is hell of a call. So how did I do it? Using the data on macro trends. First, let me just note that Hershey was on this list and towards the top of the scan results as well. They are a company that is making money and at the time was beat down and below its 200 simple moving average and 40 on the RSI. So when I made that post that I think Hershey is a good buy, it was directly on this scanner that I built and published over on my website. So over on our favorite website besides daytradingstrategies.net, when we're over on our second favorite website, Macro Trends, looking at Hershey's revenue, what I noted in my post on Twitter is that yes, the revenue growth in 2024 for Hershey was not very good. This is like not currently a great growth stock. 2024 was not a solid year for the company. But look at the growth since 2020. I mean, in 2020, we were getting quarters like March of 2020, the company made $2 billion. And in March of 2024, the company made $3.25 billion. This company has a great growth story, even if not the best year. And if we hop over and look into the price to sales ratio, because this also provides us with the stock price, you can see that, and look at the sales per share here, by the way, as well. You can sort of get the same image here in that how the company was growing and maybe flattened off, but look at the stock price, right? The stock price is at the same price it was in like the third quarter 2021. Before all this amazing growth story, you have now retraced all of that back to this same value just because of a semi-flat year in 2024. That doesn't seem right. It seems like the company is currently undervalued. And as always, like whenever I'm talking about stuff like this or going through my analysis or talking about like past picks that I've made that are good. Hershey was one that I, of course, picked in real time. I tweeted somewhere back here. I don't remember exactly where, but when I made that post, it has made a good move. That analysis I just talked about does not mean that Hershey is going to bounce. Like, oh my God, Trey found the holy grail of trading. If you can find a company that's growing and trading back at a price it was before it started growing, then the stock is going to go up. No, of course not. But it's all about, investing in general is all about putting yourself in the right situation. If I have a chance to buy Hershey stock at the same price it was 4 or 5 years ago, before it started that tremendous growth story, that is putting yourself in the right situation. Are you always going to be right? Is the stock always going to bounce? Are you always going to make money? No. That the name of this game is that you're accepting risk. The reason you're allowed to make money in the stock market is because you are accepting risk. Without that exception of risk, you'll never make money in this game. Just find the stocks that are putting yourself in the best case scenario to make money. And that sort of analysis I just talked about on Hershey was doing exactly that. And in this case, it worked out pretty damn well. Now back over on our second favorite website, looking at Tesla's revenue, let's talk the short play that I posted and introduced in the introduction of this video. Shorting stocks is half of the market. If you can make money longing and shorting, you can find more opportunities to make money in this game, right? Well, Tesla, take a look at this. This stock also, much like Hershey, was a great growth story that really didn't have a great 2024. Like, it didn't have a bad 2024. It just stopped growing. It's like a growth story that got stagnant. Once again, much like Hershey. However, unlike Hershey, if we go look at the price to sales ratio and more importantly the stock price, where Tesla was 5 years ago during its growth story, $140, $230 at the time of my post, it's trading up. I don't remember exactly where, but you can see the idea here that Tesla stock was flying even though the company wasn't growing. So it's pretty much like the same picture as Hershey, just with the exact opposite outcome. And that's why I targeted it for a short. The company has stopped growing. Once again, they're not like dying or anything. Tesla's not going down, but they're not going up. And they're trading at ridiculous ratios. I mean, its price to earnings ratio, even though it's not a growing company anymore, I mean, you can see the earnings here as well. The EPS is actually coming down. They're still trading 200 times earnings. They're still trading at the time of the spike 14 times sales. As a company that's not growing, trading 14 times sales and like whatever 100 times earnings is ridiculous. So if we go over and look at Tesla, I believe the tweet on Tesla was actually a month ago to the day. I think I posted that on February 10th, which was this day right here. So I posted here that I think Tesla is a better opportunity to the short side because the valuation versus the growth just doesn't make sense to me. And since then, the stock is down 35%. Now, I know what some sympathizers are going to say. And listen, I agree with you. Over that same time period, the market's down really hard too. I get that. But Tesla's down 35%. If we look at some like similar growth type stocks in that same period from February 10th to now, February 10th on Nvidia is here. Nvidia is down 20%. And Nvidia is actually getting hammered on bad news out of China as well. So they're dealing with their own external issues and they're still only down 20% versus Tesla's like 38 or whatever. Apple, another really strong growth stock from about February 10th, is only down 5%. Netflix has been a ridiculously strong growth stock from February 10th, is down 16%. So, like, yes, all growth stocks get hammered when the market goes down, but Tesla is still underperforming the market. Even though the entire market's coming down, you still have to judge the performance of a ticker versus the performance of similar tickers. You can't just say like, oh, well, Tesla's just coming down because the market's coming down. Well, no, it's coming down like twice as hard, if not even more than twice as hard as similar Magnificent Seven growth stocks. It is still grossly underperforming the market, even though it's following the same trend. That performance still matters. And let me jump in and wrap up this conversation with something maybe a little unrelated. I just posted this today, actually. I own a Tesla. I drive a Tesla Model 3. It's how I get to the gym in my office every single day. And as you just heard, my reasonings for why I was bearish and still am bearish on Tesla stock. Please stop, as I say in my tweet here, please stop fanboying companies or buying into like movements in the stock market. Like, oh, Tesla is this. Like, no, like you can love the cars. You can like the company. You can love or hate the CEO, whatever you think of Elon Musk. I know he's very torn right now and I won't give you my opinions on him because I'm going to avoid that topic. But whatever you think about all those external factors, don't try to apply that to your investing. Investing is a completely separate game from those sort of external factors. These kind of statistics that I am showing you on macro trends, this is what matters when investing. Not what you think about the company, not how you feel about the politics of the CEO, this, that, the other, etc., etc. You need to be able to separate those two things. I hope you learned something in this video. I hope going through the process of how I fundamentally analyze potential investments helps bring you some ideas for how to do the same. And I really hope you make use of this website, Macro Trends. Once again, I am not at all affiliated with them. I just love the data they provide and the way they provide it for tickers. Of course, I am affiliated with the website daytradingstrategies.net. Once again, this is my website. If you're interested in any of the scanners you saw today or coding in ThinkorSwim in general, click on our codes to sign up for what I have already published. Click on the course to learn how to do it yourself. Hey, hit the like button if you learned something in this video. Make sure you subscribe to the channel to continue learning for completely free. And with all that being said, I'm going to go ahead and sign out of this video, and I'll catch you on the next one.